You are listening to Uranium Spotlight, your weekly podcast on the forces shaping the global uranium fuel market, sponsored by PurePoint Uranium Group. Uranium Spotlight isn't just a podcast, it's a platform. Visit uraniumspotlight.com, featuring in-depth market briefings, sector analysis, and the free Uranium Investor Foundation series. Essential reading for understanding today's nuclear fuel landscape. If uranium matters to you, you're in the right place. And now, your host, Chris Frostad.
It's April 21, 2026, and this week on Uranium Spotlight, spot prices push higher on renewed buying. A billion-dollar royalty consolidation reshapes the sector, geopolitical tensions rise in Namibia, and enCore Energy resets leadership to drive operational performance. The uranium spot price closed last week at $86.80 a pound, up from $85 at the start of the week, marking a firm move higher as activity returned to the market. After a quiet start to the week, trading activity picked up sharply by midweek, coinciding with the World Nuclear Fuel Cycle Conference in Monaco. Market participants, many of whom had been waiting for a catalyst, saw renewed momentum driven by rising equity markets and fresh capital inflows. Financial players were once again a key driver. Sprott Physical Uranium Trust raised more than $70 million during the week and returned to the market with multiple purchases totaling 600,000 pounds. This activity helped tighten the spot market, particularly in the latter half of the week, where 17 transactions were recorded. Pricing responded accordingly. Midweek trades pushed prices from $85 to $85.65 before additional buying lifted the market to $86.80 by Friday. The weekly indicator ultimately rose $1.90, reflecting a clear shift in momentum. On the term side, activity remained relatively quiet, though importantly, new demand emerged from utilities, including a U.S. buyer seeking deliveries starting in 2027. Several additional utilities remain in the market evaluating longer-term coverage, reinforcing the underlying demand picture. For investors, the key takeaway is that financial buying continues to act as the marginal price setter in the spot market, and when combined with the re-emerging utility demand, it creates the conditions for sustained upward pressure on prices. The renewed activity following a brief lull suggests the market remains structurally tight and highly reactive to capital flows. One of the most significant corporate developments last week was Uranium Royalty Corporation's agreement to acquire Sweetwater Royalties in a $1.1 billion transaction, creating a diversified royalty platform with exposure to both uranium and industrial minerals. At its core, this is a strategic move to combine steady cash-flowing assets with long-duration uranium optionality. Sweetwater brings a massive land position across Wyoming, Utah, Colorado, and Michigan, along with existing income from soda ash production. Meanwhile, Uranium Royalty combines exposure to nearly 30 uranium projects globally. The structure of the deal is equally important. Orion Resources Partners, the current owner of Sweetwater, will emerge as the largest shareholder with roughly 43% of the combined entity, signaling a strong institutional conviction in the long-term value of the asset base. What stands out here is the scale of optionality being assembled. Sweetwater's 4.5 million acres include prospective uranium ground that has seen limited modern exploration. In a tightening supply environment, this kind of land package represents embedded upside that's not currently reflected in market pricing. Equally important is the shift in capital allocation strategy. Rather than building mines directly, the combined company is positioning itself to benefit from rising uranium prices through royalties, giving it leverage to the cycle without direct operating risk. For investors, this matters because it highlights how sophisticated capital is positioning ahead of the next phase of the uranium cycle. Large-scale consolidation of royalty and land assets suggests that the market is beginning to value long-term optionality, not just near-term production, a signal that the structural supply deficit is gaining broader recognition. Namibia emerged as a focal point last week, not just for rising production, but for intensifying geopolitical competition over uranium supply. On the production side, Paladin Energy increased its guidance for the Langer Heinrich mine to between 4.5 to 4.8 million pounds for fiscal 2026, reflecting strong operational performance and improved recoveries. This reinforces Namibia's growing role as a key global supplier. But the more important story is geopolitical. Chinese and Russian influence in Namibia's uranium sector continues to expand, with significant ownership stakes and government relationships already in place. At the same time, the United States is now actively seeking to secure access to critical minerals in the region, including uranium, as part of a broader strategic push. The challenge for the U.S. is clear. Much of Namibia's existing production is already tied to Chinese interests, and Russia has been deepening its engagement with the government. This leaves limited room for Western buyers to secure new supply without competing directly in a geopolitically complex environment. This dynamic underscores a broader issue. The uranium market is no longer just about geology or economics, it's increasingly shaped by geopolitics, supply chain security, and origin constraints. And critically, even with Namibia ramping production, it does little to alleviate Western supply concerns if that material is effectively locked into non-Western supply chains. For investors, this matters because it reinforces the importance of jurisdiction. Pounds are not all equal. Uranium produced in politically aligned jurisdictions, such as Canada, is becoming increasingly valuable, particularly to Western utilities facing growing constraints on acceptable supply sources. This segmentation is likely to tighten the effective market and support higher prices over time. enCore Energy announced a significant leadership transition, appointing Richard Little as Chief Executive Officer, while founder William Sheriff returns as Executive Chair. This is more than a routine management change. It represents a deliberate reset aimed at improving operational performance and accelerating development across the company's asset base. Little brings over 30 years of experience in the resource sector, with a track record focused on operational efficiency, cost reduction, and asset optimization. His mandate is very clear: streamline operations, improve permitting timelines, and drive production growth. The company has also outlined a broader strategic shift, emphasizing stronger shareholder communication, tighter cost controls, and a renewed focus on advancing its core projects, including Alta Mesa East and Dewey Burdock. One of the more telling aspects of the announcement is the explicit focus on permitting. Management acknowledged that regulatory delays remain a key bottleneck not just for enCore but for the broader U.S. uranium sector. Sheriff's return as executive chair adds another layer of experience and strategic oversight, particularly as the company looks to regain momentum and reposition itself within the domestic uranium market. For investors, the key takeaway is that enCore is shifting from a growth narrative to an execution narrative. In a market where new supply is increasingly difficult to bring online, companies that can demonstrate operational discipline, permitting success, and production reliability are likely to command a premium. Leadership changes like this are often early indicators of that transition, and in a tightening uranium market, execution will matter more than ever.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global energy landscape, sponsored by PurePoint Uranium Group. While our passion for the sector is undeniable, nothing discussed here should be considered investment advice. Our mission is to provide a clear, balanced view of the forces influencing uranium prices and the nuclear fuel cycle. For deeper analysis and market briefings, visit uraniumspotlight.com. Join us again next Tuesday for another edition of Uranium Spotlight,